We've seen full-year earnings at AIM-listed First Property Group come out today, and it really laid bare the unprecedented headwinds that the market has been facing. Ben Habib is the Chief Executive Officer and founder of the company. Ben, good to talk to you, and what a time it is to talk. You've produced a loss this time around of 5 million. I think you had a 5.5 million profit this time last year, but I noticed as well you slashed your debt pile, and you've increased your cash by more than double. But I also noticed that as well, and I guess this is telling, is the fact you've taken your dividend down to nothing. Describe what's been going on over this last year.
Well, we've had, as everyone knows, pandemic-induced lockdowns almost non-stop for a year, over a year now. And the impact on a physical business like ours, which requires the comings and goings of people, either into shops or offices, has been dramatic. It actually puts into shade the 2008 recession. This is much worse for property than anything we've ever seen before, and I've seen in my career. We've had a perfect storm where tenants haven't been able to use their properties, where tenants have been forgiven their debts by government, and in the case of the United Kingdom, contractual obligations have effectively been suspended. So we've seen naturally a difficulty in maintaining income, a difficulty in renewing leases when leases came up for renewal, and we've also seen some tenants go bankrupt. And what we've effectively, the net effect of all of that is for property values to drop. And actually, they haven't dropped quite as far as they would have done without QE. I mean, QE has been a saving grace in a sense for anyone who owns assets because it buoys up the market. But you can't get over the economic gravitational pull downwards of the inability to trade and the suspension of contractual obligations, which is what the pandemic effectively has amounted to for property companies. And so, not unlike other property companies, in fact, I think we've done a lot better than some. Our collection rates have been over 90%, as you might have seen, Jeremy. But, whereas the market's been around 60%, and those property companies that specialize in retail have only had collection rates of 40%. Can you imagine? That's decimating. But notwithstanding our good collection levels, even a reduction of 5 or 10% in rent collection is really very meaningful when it comes to value hits. And it's the value hits that take your profit down. So the biggest impact that we've experienced this year was the inability to renew the lease at a property in Gdynia in Poland to the main tenant there, to a company called Seco. We failed to release it to them, even though terms had been agreed. And because we failed to lease it to them, the property value plummeted. It went below the value of the debt secured upon it. And I would have thought, given that the debt was non-recourse, that we wouldn't have to account for that negative net asset value, as it were, coming out of that property. But IFRS rules require that we do it. And of the 10 million swing that you mentioned, 5 million profit last year, 5 million loss this year, of that 10 million swing, 7 million of it was a reduction in value of that property. So a very significant impact coming, from one property alone.
How has this year started, and is there likely to be a snapback? I guess part of that is going to be how you continue with that valuation of that property in Poland.
There will be a snapback in the valuation of that property because after the year end, we did a deal with the bank whereby they wrote down the value of their debt from 25 million euros to 16 million euros. So that's a 9 million kickback into profits that we will experience for the year to 31st March 2022. But on an underlying basis, we're not going to get a rapid snapback. We're going to take a year or two re-letting the vacant space. We've got 13,000 square meters, over 13,000 square meters of vacant space in Gdynia. We've got 25,000 square meters of vacant space at a business park in Krakow. We've got 4,000 square meters of vacant space in an office in Warsaw. So we've got quite a hurdle over which to get in order to, get back to trading as normal from this pandemic. We will get there, but they've got large amounts of space, and it'll take a year or two, possibly 3, to get them fully let, at proper rent levels.
I think in your property fund management business, I'm correct in saying, aren't I, that in fact you are actually weighted positively here in the UK. 66%, I think, of it is UK property, isn't it? And I think only 30-odd% is in Poland, a very small percentage in Romania. How do you see that changing? Is that something you're going to be addressing? Are you going to be shifting things around so you get a different emphasis in different areas, or are you happy with that spread as it is at the moment for the recovery?
We're very happy with that spread. We're agnostic, actually, about which jurisdiction we're in. We're very deal-led. So if we find properties in the UK that we think are worth buying, we'll buy them. If we find properties in Poland we think are worth buying, we'll buy them. And we won't be looking really to balance that particularly. What's interesting, though, and I just draw viewers' attention to it, is that even though we're 66% in the UK, what we have in Poland, we, to a very significant extent, either have minority interests in those properties or we own them outright. So our profit flow actually from Poland is in excess of 75%. 75% of the group's earnings come from Poland, even though it's a much smaller proportion of assets under management. The UK funds are mainly on behalf of third parties. And I think what we might see going forward is an increasing proportion of direct ownership of First Property Group in British properties.
I mentioned at the top that you've seen a big increase in your cash. I think it's gone up from something like 7.3 to 16.2 million. It comes at the same time you say there's no dividends this year. Now, I know you're going to get some investors saying, well, hang on a minute, we want to share in some of this extra cash you've got on the balance sheet. What is that cash now earmarked for? You mentioned opportunities possibly in the market. I guess you've got to be cashed up, ready to go for those as and when. But as I said, investors possibly looking at this with some envy.
Yeah, well, we were very lucky or prescient. I can't take the credit for this, but I think we were lucky. We sold our largest property last year just as the pandemic was kicking off. And that released £17 million worth of cash into our balance sheet, which has underpinned us in this very difficult period while we've had to take hits elsewhere. And the reason we've cut the dividend is because it's imperative that we use that cash to build the group back, to build our earnings back. And only once we build our earnings back can we be confident in paying a dividend. And you'll be, if I can draw your attention to the language we used in my statement, I mean, basically what I said was that we would not be paying the final dividend this year, but we would look to reinstate it at an appropriate juncture. So we're not looking to gradually build it back. What we're looking to do is get through this period of uncertainty, lease up the vacant space we've got, do a couple of clever deals, of which I'm pretty confident, and then reinstate the dividend in one fell swoop. So we're back to where we were before the pandemic kicked off.
How has Brexit played out in all this? There have been surprises, I know, that have been thrown up by the new relationship or otherwise that we now have with the EU. How has it affected your business? What has it unfolded in a different way than you expected?
Well, I mean, Brexit has been, in a sense, it's a sort of backstory. It's in the background, but we haven't really been able to assess what the impact of Brexit's been, because the impact of the pandemic economically has been so vast. It's difficult to really know what's Brexit related and what is pandemic related. As far as occupational demand in British property and Polish property is concerned, I don't think Brexit's made any difference at all. And as far as our ability to operate in these two different jurisdictions, Brexit's made no difference. So the jury is out on, what the net effect of Brexit might mean for First Property Group. I've always taken the view, and I still take this view, that Brexit is good for the United Kingdom, that handled properly, it should boost the United Kingdom's economy. And if it's good for the United Kingdom and boosts our economy, then it will be good for First Property Group. We can't but help ride on the coattails of the UK's economy.
One final question. We've just had the Bank of England come out with its interest rate decision. No change in rates, of course, base lending still at 0.1%. One of the hawks on the committee has voted to try and claw back some of this quantitative easing that is out in the market at the moment. But on the whole, it has remained at 875 billion. You mentioned the help that quantitative easing has given to the sector. But the Bank of England also warning that inflation could rise to 3%. What does all this mean to a company like yours? I mean, clearly there is a concern about the potential for a rise in interest rates at some point, although the bank is not warning that even at 3% CPI, which it's saying could be an outlying number, it won't actually stir them into raising rates unless it becomes entrenched. What is your message to the Bank of England as an owner of a business that is, to some degree, reliant on this sort of current environment remaining?
Well, I'm not a fan of quantitative easing. I think it is obviously the devaluation of cash, which means those people in our country who worked hard and saved are actually being punished, for nothing that they've done. So I'm not a fan of QE, but QE has been utterly critical in making sure that businesses don't go bust across the United Kingdom during lockdowns. And it would be incredibly premature now to reverse QE or to start raising interest rates unless it becomes very evident, and we've given it a really good test, that inflation is becoming entrenched. What we've got at the moment, Jeremy, is 4 million people still on furlough. We've still got lots of government cash in the system. We've got broken supply chains. We've got people not working. So what we have is a slightly artificial boost to demand, which has had a disproportionate effect on inflation because supply chains are broken. And we're also seeing a bit of wage growth because people are still on furlough. But actually, when the furlough scheme ends and you get people coming back into the job market, many of whom actually may not come back into the job market, they may join the ever-growing large underclass of the disenfranchised and overlooked in the United Kingdom. But there will be another economic setback when furlough ends. And we've got to wait for supply chains to mend. Global supply chains, national supply chains have been broken by the pandemic. We've got to wait for them to mend. We've got to wait to see what the result of the end of furlough is. And only once we've seen where all that settles can the Bank of England really begin to judge inflation properly. And at that point, they can then decide whether to put up rates or not. But I think it would be wholly premature to do it right now.
One final question. This time next year, where do you hope and believe things will be? I think if I can bring up a share price chart, just to show people what's happening at the moment. There's been this big drop in today's trade. I guess partly that is because of the fact that it's difficult to know when the dividend's coming back, and the way you describe the current environment. What's your best hope for next year, and what can you tell investors in this stock at 27.5 pence?
Well, I think we've got a year or two of recovery, at which point we should hopefully reinstate the final dividend. And then I think we will see a snapback in the share price. The share price is, it's an immediate reaction to our falling into loss. But when you look at it, as I mentioned, 7 million of that swing is down to one property which became vacant and fell below the value of its debt. We're going to get an automatic accounting swing back this year from it. But the real snapback, if you like, in the share price is going to be when our dividends reinstated, and I'm absolutely sure we will be reinstating it within the next year or two.
Well, look, good luck with everything. Thanks indeed for joining us, Ben. It's been a pleasure to catch up with you again with these fully numbers, full explanation about what's happening at the business. Thank you for joining us. That's Ben Habib. He's the Chief Executive and founder of First Property Group. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.